The reason this chart is so powerful is that it has historically never failed to signal an overvalued market and an upcoming decline. If you think about it, the valuation of the stock market ultimately comes down to US dollars and the amount of them in the economy. As the pace of dollar injection into the economy increases, so does the stock market's valuation. Therefore, there needs to be an indicator that clearly shows whether markets are growing in line with the money supply, growing faster, or lagging behind. Right now, the stock market is behaving in a dangerous way. As you know, the S&P 500 recently hit an all-time high in June and continues to rally. However, we should not look only on the growth of the S&P 500 as a whole, but rather under the surface at what's really happening at those 500 firms. There's something called the RSP index, which basically includes the same 500 firms as the S&P 500, but it weighs them equally, meaning the contribution of big firms like Apple influences the index the same way as a much smaller firm like the Gartner Inc. Over the past 2 years, this equally weighted RSP index has significantly underperformed the traditional S&P 500, and the gap continues to widen. The Magnificent Seven, which comprises a handful of massive tech companies, have surged by 130% over the last 2 years. That discrepancy highlights an important reality. While the S&P 500 is often used as a measure of the US economy's health, the average American company isn't doing nearly as well. When people say the market is strong, what they often really mean is a few giant companies are strong. Let me show you just how over-reliance dangerous is. The 2000 to 2002 stock market decline, the so-called dotcom crash, was largely driven by extreme over-reliance on a small number of technology firms. In the years leading up to the collapse, investor capital had increasingly flowed into internet and tech-related companies, many of which had little to no earnings. This concentration of both market weight and investor expectation created a fragile structure. The Nasdaq, which is heavily composed of these speculative tech names, experienced the sharpest decline, falling over 70% from its peak. The S&P 500 was far more diversified, but it was not immune to extreme decline. It, too, was pulled down by the collapse, falling around 45%. We don't consider this a tech bubble bursting, but rather a market-wide crisis triggered by the dominance of one sector, in this case the tech. An absolutely super important fact is that right now, Warren Buffett is holding a record amount of cash. At the end of the first quarter, Berkshire Hathaway's cash position reached $347 billion, the highest level in its history. This reflects a cautious approach in the current market environment, where valuations are high and a small number of stocks are driving most of the gains. It's not the first time Buffett has done this. Before the dot-com bubble burst in the early 2000s, he also held back from investing heavily, which led to his portfolio actually underperforming the S&P 500 during the final stretch of that rally. Yes, as you see here, Buffett actually did worse than most investors at that time. However, after the bubble collapsed, the situation changed dramatically. While the broader market fell sharply, Buffett's more conservative positioning began to outperform. The pattern now looks super similar. He is in fact again holding back, not finding many opportunities he considers reasonably priced. A cash position this large suggests he sees more risk than reward in the market at current levels. Since Buffett is holding record cash position, we're taking this very seriously into our analysis. All of this brings us to a key point. The stock market can be overvalued or undervalued, and it doesn't always depend on whether just the big tech firms are stretched or the whole market is. What we've seen again and again is that when only a few stocks get overheated, the fallout can still be broad. Sharp declines usually tend to follow, and it often takes years to recover back to previous levels. At Gleneus, the main indicator we look at is the relationship between the stock market and the money supply. More specifically, we look at the M2 aggregate, which tracks the total amount of liquid money in the economy. This is important because as more dollars enter circulation, there's more spending, more demand, and eventually more earnings for companies. That pushes prices up, both in goods and in stocks. In other words, when money supply grows, it's natural for the market to grow as well. That's why the flow of money into the system is such a key factor. If we chart the M2 money supply against the S&P 500 or the Dow Jones, we see a very strong connection. Particularly interesting moments are when the market rises well above the pace of money growth. That's when it starts to look like bubble is forming, an incorrect valuation. At Gleneus, we see that as a warning sign, a signal that the market may be in a bubble. Right now, the gap is wide. The market is well above the M2 curve, which points to a massive overvaluation. Whether it's caused by all firms or just a few, the outcome is often the same, and that is a correction. This way of thinking isn't new, because we've actually based this technique on what Warren Buffett has long used, a similar method, known as the Buffett Indicator, which compares total market value to GDP. But we believe using M2 gives a clearer picture, because GDP is based on estimates and can be revised later. M2, on the other hand, is a defined number. It includes cash, deposits, and other liquid funds, and it's tracked with precision. When we compare major indices like the S&P 500 Dow or Nasdaq to M2, we clearly see how far current valuations have stretched, and this time, given all indices, it looks like a lot. We can even look at the S&P 500 divided by M2 as a ratio. Right now, that ratio is more than double the level of the M2 curve. A big part of that comes from the COVID-era stimulus, when the Fed injected trillions into the economy. That money flowed directly into markets. And now, the market is sitting on top of that inflated base. As you see, only 2 other points in history have reached this level. As always, this is not financial advice or a recommendation to buy or sell. We provide you with our view and take on macro analysis with regard to the markets. Thanks for watching. This is Glennius.